Alright, for this video tutorial I want to go over a sample Form 5471 filing for a U.S. person that has an ownership interest in a foreign corporation. So the 5471 is a very long and complicated form, so this is going to be video one of a multi-video series that I'll make a playlist. So after you get through this one, if you jump on to the next one and so on, you get a fuller picture as to how to complete the form in its entirety. Now, before I go into the 5471 and page 1 here, I do have a couple of slides here. So we want to get into the sample fact pattern that we're going to be working with for the CFC and the U.S. person. So we'll look at the structure chart. We'll look at some more details on the fact pattern itself and who are the parties involved. And then also I want to cover just some high-level basics on the 5471 and CFC, so Controlled Foreign Corps. So to start just from the very beginning here, right, what is the 5471? Well, this is an informational return that is filed whenever a U.S. person has some type of interest that meets a certain category of filer in a foreign corporation. So the 5471, it's not filed by itself, so you would not complete this and submit it to the IRS alone. It's filed alongside the U.S. tax return for the U.S. person. So if we have a U.S. individual that is a shareholder in a CFC, they might be completing the 5471 and it's attached to the 1040. If we're doing this for a U.S. partnership that needs to file a 1065, maybe that partnership is a shareholder in a CFC, and so it's filing 1065 every year, and then it would be including the 5471 alongside with that federal return. Okay, so it depends on who the U.S. person is and what type of tax return they are filing. Now, the 5471 is filed by all U.S. persons that fall within one of those categories of filers. So we'll get into those in more detail on the next slides. But within the Form 5471 instructions, they do have a listing of categories of filers, and then they also spell out for you in a table, depending on what category of filer you are, will drive what type of schedules you need to complete with the 5471. Now, generally speaking, more times than not, this thing is filed when you have a U.S. person that is an owner or a shareholder in a foreign corporation that meets the definition of a CFC or a controlled foreign corporation for federal tax purposes. And so why is that important? Well, at a high level, the IRS wants to know anytime U.S. persons have investments in foreign assets, right? So foreign assets, foreign financial assets, foreign bank accounts, lots of disclosures anytime a U.S. person has an ownership interest or control, or perhaps they're an officer or director over one of these foreign companies. The second reason is foreign corporations. The idea is, well, if a foreign corporation doesn't pay you any income or distribute any dividends, you don't have to pay tax on the earnings. And that's just not the case, right? So foreign corporations, if they're CFCs, there are certain kind of pass-through or anti-deferral tax rules, such as Subpart F income, GILTI income. We'll get into those later. But if a U.S. person is an owner in a foreign corporation, there might be an income inclusion, meaning that they might have to record some type of income flowing through from the foreign corporation, even though they didn't actually get any cash for the year. So it kind of turns a foreign corporation into a pass-through entity. So what is a CFC? So a foreign corporation is a CFC where more than 50% of the total combined voting power or value of all classes of stock is owned by U.S. shareholders on any day during that tax year. So under Section 951B, a U.S. shareholder, for purposes of these CFC rules, is going to be a U.S. person that owns 10% or more of the total combined voting power or total value of the stock. Now, why do we have to be precise about this definition here? Well, the best way to look at this is examples, right? So it's very important to analyze, okay, who actually qualifies as a U.S. person, and then does the collective amount of the ownership of the stock give rise to this 50%, more than 50% of the total to make it a CFC. So if we have this first example here, we have Jack. He's a U.S. citizen and he owns 65% of a foreign corp. His friend Bob, who is a French citizen and tax resident, owns the remaining 35%. Now, Jack, because he owns 10% or more of the stock, he first qualifies as a U.S. person, right? So that's very important. We have to track who are the U.S. persons. And then if we look at the overall ownership, more than 50. So it's got to be more than 50% of the total stock is owned by those U.S. persons. So this example, you would have a CFC. Now, in this second example here, what if we had Jack, who's a U.S. citizen, wants to form a foreign corp. He gets 10 of his college friends who are all also U.S. citizens, so these are all U.S. persons, to open this foreign corp. Jack's going to own 20% of the corporate stock, and then each of his buddies are going to own 8%. So we've got 11 people in here. One person owns 20. Everybody else just owns 8%. So do we have a CFC? And the answer is no. Right, so Jack is still a U.S. shareholder because he owns 10% or more of the stock, but because when we look at the rest of the ownership structure, none of his other friends are going to count as U.S. shareholders because their ownership falls below that 10% threshold. Right, so you need to basically hit both values here. Right, we've got to have U.S. persons that meet this 10% or more threshold, otherwise it doesn't count, and more than 50% of the stock has got to be held by those U.S. persons. So this would not be a CFC, but as I do note here, we could still have a PFIC. So passive foreign investment company, completely separate rules. We're not going to go into those in this video because it's beyond the scope of it, but also something to kind of keep in mind. So let's look at the categories of files here. So categories of filers, there are 9 total categories now, and so these are the 9, right? We have 1A, 1B, 1C, 2, 3, 4, and then 5A, B, and C, right? And what will often happen is, and what you'll see in this example, is many U.S. persons might qualify for more than one. And we'll see in our fact pattern that our individual basically qualifies for almost every one of them. But it's very, very important to review the form instructions for a complete list of what kind of fact patterns and factors make a person qualify for any one of these categories. And again, it's very, very common that you might have individuals that meet multiple different types of categories, and so they have to include a lot of schedules with the 5471. Okay, so Category 1A filer, let's look at that one. So Category 1A filer is a U.S. person that owns 10% or more voter value of the stock, and the specified foreign corporation rule within that category is you have either a CFC, so that's a controlled foreign corporation. Again, we're going back to it's got to have more than 50% ownership by U.S. persons, or it could be a foreign corporation that has a domestic corporation, so let's say a Delaware C corporation, as a shareholder, right? If we're in that position, then we have a Category 1A filer. Category 2 filer could be a U.S. citizen or U.S. tax resident who is an officer or director of the foreign corp. So this is a person that doesn't necessarily have to be an owner, right? They could just be an officer or director. And during the year, a U.S. person, so this is either them or somebody else, acquires stock which meets that 10% ownership test, right? Or it's somebody that already had enough stock and they required an additional 10% during the year. That would be a Category 2 filer. Category 3 filer here, U.S. persons who acquired stock to meet that 10% ownership requirement. Again, this can be an existing shareholder. So that's one way you can meet that Category 3 filer. Or you have a person that becomes a U.S. person, right? So let's say you have a shareholder that's already an investor there, and then they move to the U.S. and become a U.S. green card holder. That's them becoming a U.S. tax resident, so that would also make them a Cat 3 filer. Another one would be a U.S. person that sells some of their stock. So if they sell stock in that CFC and it pushes their ownership below 10%, that would make them a Cat 3 filer. Or you could have a U.S. person that owns a certain ownership interest in a foreign captive insurance company. So that's captive insurance companies are basically offshore insurance companies that are wholly owned by another company, and so it's a form of kind of self-insurance. Again, beyond the scope of this video, because that gets a little more complicated when you have those scenarios, but also I just wanted to highlight it there so you could see a complete listing of what would make a Cat 3 filer. Now, Cat 4 filers, these are U.S. persons that had control over the foreign corporation. So again, we're going U.S. person, so that's, they meet the 10% ownership test. but their control, so they own so much of this stock that their control is more than 50% of the voter value of the foreign stock. So this very commonly happens with wholly owned companies, right? So if an individual just wants to set up an offshore corp, they're a 100% shareholder, they're going to be a Cat 4 filer, right? Because they own more than 50% of the stock, so they have a controlling interest. Now, Cat 5A filers, right? These are U.S. shareholders that own 10% or more of the voter value of the stock, and then this is a foreign corporation that is a CFC at any time during the year. Now, a lot of these seem like they're overlapping, and that is quite often the case, but there are subtle differences between the different types of categories. And so when we look at the chart later on, you'll see that a lot of these categories are filing the same schedules. So when we get a look at the full list, it's going to seem, it's going to seem like there's overlap, and I think that's frankly done by design, right? They want a lot of information from you whenever you've got to file these 5471s. Okay, so let's move on to the types of income that we might have to worry about here. So when you have a CFC, CFCs can be subject to taxes in the U.S., and foreign jurisdictions as well. But when we think about it from a U.S. tax perspective, they can be subject to taxation in the U.S. either directly or indirectly. And so what do we mean by direct taxation? Well, direct taxation would be a situation where you have a foreign corp that's a CFC, but it is engaged in U.S. trade or business. Now, I have separate videos on this, so I can put some links to that below. We're not going to get into this too much detail here. But when you have foreign corporations that are engaged in U.S. trade or business and have what's called ECI, effectively connected income, the company itself has to file a tax return in the U.S. and pay tax almost as if it was just a regular Delaware C corporation. So the foreign company would have to file 1120F. It would pay corporate income taxes on a net basis. And it would also be subject to BPT or the branch profits taxes on any net reduction in U.S. equity. Okay. Now, the reason I want to highlight that is important because there are many scenarios where you could have to file that and the 5471. And what I see often done incorrectly is a lot of people will identify, okay, I have a CFC, so I'm going to go through all the trouble of filing 5471. But they forget to analyze whether or not the CFC also needs to be filing an 1120F, right? Very, very important, right? You can have scenarios where you're filing the 1120F because you have U.S. trade or business, but you also have U.S. shareholders to make it a CFC. And so the U.S. shareholders are taking care of their end with the 5471s, and then the company itself is having to file an 1120F and pay taxes. And, frankly, you can't do the 5471 in this scenario without that 1120F being completed. And I'll touch on that later when we get to one of the schedules. But effectively, when we talk about Subpart F income and GILTI, your Subpart F income and your GILTI inclusions are reduced by any income that was subject to tax in the U.S. as ECI. So that's why you have to do the 1120F first, figure out how much tax you owed on the income, and then you can make the appropriate adjustments on the 5471. Now, the indirect taxation is what people are more familiar with, frankly, and these are the income inclusions which apply regardless of whether any cash was actually distributed to the owners. So we have two income inclusions here. We have Subpart F income and then the GILTI. GILTI is the Global Intangible Low Tax Income. So sections 951 and then 951 Cap A. Now, in the example we're going to be looking at, we're going to be dealing with foreign-based company income. So Subpart F income includes a lot of different types of income. So insurance, foreign-based company income, international income related to boycotts, certain types of illegal income. These are types of income that the U.S. government wants you to pass through as if you did take the cash distribution even though you didn't. So they don't want you to be able to defer these earnings overseas until you repatriate the funds. They want to get it now. And similar issue with GILTI, right? So GILTI was enacted under the TCJA, so that was the Trump administration's tax reform. And guilty was intended to kind of capture what Subpart F income didn't. So companies would move easily, quote, easily movable assets, so intellectual property, things like that, to foreign entities and try to reduce their overall U.S. tax footprint. And so guilty is designed to capture these types of income that otherwise could be excluded from Subpart F. Now, very, very important here, this last note. Very often, and it's not only just possible, but very common, where U.S. persons are filing 5471 and there is no income inclusion, there is no tax. So one mistake you do not want to make is assume that because there's no income inclusion and no tax owed, I don't have to do the 5471. That is 100% not the case. The Form 5471 has to be included if you meet the category of filer, even if there might be no income to report and no tax, right? So very often taxpayers will believe, oh, well, if I didn't owe the IRS anything, I don't have to do this. Not true at all, because the disclosures are still what they're after. Okay, now let's look at the fact pattern here, and then we'll jump into the actual page 1 of the 5471. So the 5471 fact pattern we got here. So let's look at the structure chart first. I think this will be easy to start with. So here's what we've got. The 5471 we're going to be completing for John Q. taxpayer. So he's the U.S. resident and U.S. citizen here, and he owns 75% of this Cayman Islands company. So there's going to be a Cayman Islands company. This is the CFC. He's a 75% owner. And then the other owner that's coming in here is Jane Doe. That's a friend of his. She's a Bermuda citizen and resident, and she's going to own it via her Bermuda holding company. Okay, so that's broadly kind of what we're working with here. Now let's look at the details a bit more so we kind of get a full landscape here is what's going on. So we've got, again, John, he's the U.S. citizen. They're going to form a non-U.S. corp, and they're going to be investing in stocks and bonds in non-U.S. financial markets. So they're going with a Cayman Islands company. John's going to own 75% of the Class A common stock, and Jane is going to own the remaining 25% of the Class A common shares. Now, as we saw in the structure chart, Jane is not going to hold her stock directly. She's going to invest in another foreign corporation, which is going to be her Bermuda holding company. Okay. Now, in addition to this, some extra facts that we'll have that'll be relevant when we do the return. The Cayman Islands entity is going to be the beneficiary of a U.S. grantor trust, right? So U.S. grantor trusts are effectively kind of disregarded in that the income and expense just pass through directly to the grantor in this case, right? So that's the Cayman Islands entity is the grantor and the beneficiary. And then in addition, we have John here. He owns an accounting company in the U.S. Now, the accounting company is not owned by the Cayman Islands entity. It's not owned by Jane. It's just owned by John. But the reason this is going to be relevant is because the two entities are going to do some business with one another. And I'll show you on Schedule M how that relationship needs to be disclosed, okay, for the outsourced accounting services. So John is going to be, he's a U.S. person, he's a U.S. citizen, and he's going to qualify as a U.S. shareholder because he owns 10% or more of the stock, right? So he's a 10% or more shareholder, so he's a U.S. shareholder. So this is going to make the Cayman Islands entity a CFC for U.S. federal tax purposes. Now, so because it's a CFC and John is a U.S. person, he's very likely going to fall within one or more of those categories of filers. So he's going to have to do a 5471 and include all those required schedules with his Form 1040. Now, what is the income going to be earned within the company? The CFC is going to earn interest income. It's going to earn some dividends. It's going to realize some capital gains and losses from the sale of securities. And so that gross income is going to include interest, dividends, capital gains, etc., right? Now, this type of income, if we look at the Subpart F income rules, is going to generate what constitutes foreign-based company income, specifically foreign personal holding company income. So if we look at IRC Section 954C1, This is going to be the foreign personal holding company income. So it's basically portfolio income. That's really what it is. So that falls within the Subpart F income category. So we are going to have some Subpart F income inclusion, okay? We'll take a look at the financial statements to show how that's calculated, but this is what we need to be mindful of is we have a CFC, we have foreign personal holding company income, so we're likely going to have Subpart F income. Now, what kind of categories is John going to qualify as? Well, he's basically going to be almost all of them, right? So he's going to be a 1A, he's going to be 2, 3, 4, and then a 5A. So we'll look at those in more detail on page 1 when we get to it, but that's something to keep in mind here is based on this fact pattern, a pretty straightforward fact pattern. He's going to hit all of these categories, at least on the first year of formation. We'll touch on later how in subsequent years some of these category items might drop off and he doesn't have to do those schedules anymore. But for the first year formation in this type of fact pattern, he's going to be hitting all of these. All right. Now, before we look at the all the details for the fact pattern, what we want to assume here is that the CFC is not going to be engaged in U.S. trade or business, and it's not going to have any ECI. So we're not filing a Form 1120F. You remember on the previous slide, I highlighted how if you have a CFC that's engaged in trade or business, you need to do this first and then the 5471. So we're going to assume that this would not apply given this fact pattern, so we're not doing an 1120F. Okay? So again, just to touch on the fact pattern again here, we have John owns 75%. Jane owns 25%, but it's via her holding company. So she owns 100% of this holding company, and then the Bermuda company holds her 25% of the Class A common stock. And then over here, separately, we just have John's accounting company owns 100%, so that's just his. Again, Jane has nothing to do with that. And then the Cayman Islands company here owns 100%. It's the grantor and sole beneficiary of this revocable grantor trust, which is going to be a U.S. trust set up in Delaware. Okay, now, so what are the schedules that are going to be required? So if you look at the Form 5471 instructions, within one of the pages there, they have this table. So I've just taken a screen grab of this and pasted it in here on my slides. But you can see the category filer across the top here, and then a check mark for each schedule that would be required depending on your category. So remember, John is going to be, he's 1A, 2, 3, 4, and 5A. So you can see all of these check marks here. There is some overlap. So basically, if you're a Category 4 filer, you're doing practically everything. And then in our case, we are hitting 2 and 3 for this year. So we're touching every schedule. Every single schedule is going to be completed given this fact pattern. Okay? Okay, so now when we look at the page 1 of the 5471, now we'll actually start getting into kind of the meat of the return here. This is page 1, mostly just identifying information on the U.S. shareholder that's filing this and some information on the CFC, or this foreign corporation. Okay, so at the top here, we've got the accounting year, tax year for the foreign corporation itself. Now this company, we are saying it was formed on March 1st, right? So March 1st, 2021. So the tax year wasn't for the full year. It was starting March 1st, 2021 and ends at December 31st, 2021. Okay, if you've got a full year CFC, then you can leave these blank because it would just be for the whole year, right? The name of the person filing the return, this is the U.S. person. So we have John Q. Taxpayer. His address, his identifying number is his Social Security number or ITIN, or if you're filing this for an entity, it would be the EIN. Okay. Now the category filers, remember, John is hitting all of these, right? So 1A, he's a U.S. person that owns 10% or more of the stock, and this is a CFC, so he's a 1A category filer. Category 2 filer is a U.S. citizen who's an officer or director of the foreign corp, right? Again, it's not necessarily an owner, but it's also a U.S. officer or director where a U.S. shareholder acquires the stock. In this case, John owns 75% of the company. He is not only a shareholder, but he's going to serve as an officer or director, so he hits the Category 2 filer requirement. Right? Now, Category 3 filer is, again, this happens whenever a U.S. person acquired enough stock to meet the 10% ownership requirement, or it's a person that disposed of stock below that 10% threshold, right? In John's case here, he acquired 10% or more, and so he's going to be a Cat 3 filer for this year as well. So now Category 4 filer, this is a U.S. person that has control over the foreign corporation. Remember, John is going to own 75% of the company. He's a U.S. person and he owns more than 50% of the stock, so he is a controlling shareholder. That makes him a Category 4 filer, right? And then the last one for John here is he is a Cat 5A filer because he is a U.S. shareholder, owns 10% or more of the voter value of the stock, and this is a corporation that was a CFC at any time during the year. Okay, so that's why we're checking all these boxes. For the 5B and C's and 1B and C's, have a look at the instructions for what scenarios would apply there. Again, they're more unique, so I'm not touching on them here, and they're not going to be part of this scenario. But if you are interested in learning what scenarios would be within that section, go ahead and have a look at those instructions. Now, the filer's tax year, this is the U.S. person's tax year, right? So in this case, we have John Q. taxpayer. His tax year is a calendar year, right, because he's a U.S. person. And that's an individual, so individuals always use their natural year is just the calendar year. So January 1st, 2021 through December 31st, 2022. Now the checkbox down here, check if this is a final form 5471. It's not, right? This is an initial year return. But if this was the last 5471 you're filing because either the U.S. person sold their shares or the company was closed down, then you would check that box. Now, box C, I do have it checked here. This is, again, beyond the scope of this video, but U.S. persons are also required to file Form 8938 for any specified foreign financial assets. And so if you have an interest in a CFC or other foreign corporation, and you would otherwise have to disclose it on the 8938, you can omit the disclosure on 8938 if you're filing the 5471. So on the 8938, there's a section where you can say, I have foreign financial assets, but I'm not reporting them on this form because I report it on the 5471. So you check a box, you mark 5471, and then on this 5471, you do the same. You check line E there that you are reporting accepted specified foreign financial assets on this form, but you're not duplicating the information on the 8938. For the next line down, check this box if the 5471 is completed using alternative information under RevProc 2019-40. So we are not using the alternative information procedures under RevProc 2019-40. This would apply when you have what are referred to as Section 958A, so unrelated shareholders. And the idea here is if you're an unrelated shareholder and you have to complete this form, but you don't have access to a lot of information, there is a safe harbor where you can use certain types of financial statements in accordance with this RevProc, and it kind of provides you some penalty relief if things are incorrect. Again, beyond the scope of this simple example, so we are not using anything, any of the alternative information procedures under 2019-40. Now, persons on whose behalf this information return is filed. It is possible and okay for having one U.S. person file this form for all other U.S. persons that are CFC shareholders, U.S. shareholders. So if you did have multiple U.S. shareholders, you could list their names, addresses, ID numbers, and then check whatever appropriate boxes they are. So are they a shareholder, officer, director? Are they all three? The form does get more complicated because you have to kind of duplicate certain schedules within the form to show particularly how much income might be allocated to the remaining shareholders. Again, in this example, I'm trying to keep it pretty simple, so we only have one U.S. shareholder. So John is not filing this on behalf of anybody else. Now, in the next section down here, name and address of the foreign corporation, pretty straightforward, right? So we have the fake offshore company limited. This is the Cayman Island entity. Put the mailing address for the Cayman entity. Now, employee identification number, this is the U.S. EIN that might be assigned if needed. In this case, the company doesn't have one because it didn't need it, but If, for example, you did have to file, let's say, an 1120F, then you would need an EIN, right? And so you would have the EIN listed there because the company can't file an 1120F without having an EIN. Reference ID number. This is kind of, it's an ID number in lieu of having an EIN. So if you don't have an EIN, you have to put in a reference ID number. It can be anything. You can make it up. The name and any string of additional characters. It just has to be unique to you. And what's more important is going forward, you have to keep using the same reference ID number. Don't change it in subsequent years, because this is how the IRS system is going to track you filing the 5471s for this entity each year. Country under whose laws incorporated, quite simply, where did you set the entity up, right? So this entity was formed under the laws of the Cayman Islands. And we have the date of incorporation there. Again, this entity was set up March 1st. Principal place of business is the Caymans. Look at the principal business activity code. You can find those in the Form 1120 instructions, has a good list. What kind of business activities are being conducted? We have investments. And then the functional currency code. Now, this is a foreign company. Very likely the functional currency might be a different currency. The Cayman Islands, Bermuda, a lot of these let's call them tax havens or financial hubs. You are allowed to maintain books and records under US dollars or an alternate currency. So in Cayman, they have their Caymanian dollar. KYD, I think, is the currency code, but you don't have to use that. Bermuda, for example, BMD, the Bermuda dollar is actually pegged to the USD, so that's why a lot of Bermuda companies just US dollars. But in this case, our books and records are just kept in US dollars, so that's our functional currency. Now, if you have an agent or branch, office, whatever it might be in the US, you can list that here. In this case, we have none. And then in section B here, it does ask if a US tax return was filed for this entity. And the answer is no, right? So if you filed an 1120F, you might enter the taxable income or loss, the amount of tax paid. But in this case, we're not filing 1120F, so we've had no return filed for this entity. In box C here, it asks for the foreign corporation's statutory or resident agent. Very similar in the U.S. to having a point of contact or a registered agent in a state that accepts service of process. So they're using a Cayman law firm as their resident agent, and then they have their accounting is being done by a Cayman Islands accounting firm, and then again, in addition, we'll have the relationship with the U.S. accounting firm that John owns, and we'll show how that is disclosed. Now, Schedule A here is the first schedule that comes up with the 5471. So simply lists out the stock of the foreign corporation and how many shares were issued and outstanding at the start of the year and at the end of the year. So in this case, remember the fact pattern, we just have one class of stock. So we have common stock, one class, so Class A. Obviously, this is a new company, so at the beginning of the year, we didn't have any stock issued and outstanding, but at the end of the year, they had 1,000 shares. So 750 shares were issued to John, and then 250 shares representing 25% were issued to Jane's Bermuda Holding Company. Okay, so that is the first page of the 5471, and that concludes this video. Stay tuned or skip forward to the next video where we go into Schedule B, C, and so on, and all the other remaining schedules that are going to be required, given that John is a U.S. person with this many different categories. Okay, thank you for watching, and I look forward to seeing you again on the next video.